from Bernstein to understand consumption a bit better and how these earnings are panning out. Jignanshu, hi, morning. Great to be speaking with you. Let's talk about Trent first, Jignanshu, because, you know, like you said, over-cannibalization of the micro-market demand. I think the question really is, whether the aggressive store expansion is sort of reaching a point of diminishing returns, and how long can they sustain these kind of margin levels, and would they be range-bound going forward?
Okay, thank you so much for having me here. Always a pleasure. I think Trent is going through a reset of its Zudio strategy, like it did a reset of its West Side strategy maybe a couple of years ago, where they realized that the Zudio growth of stores, especially in the urban micro markets, has been beyond what it should have been. A more gradual approach would have been probably more sustainable. And they focused on the micro market share. Like that led to some diminishing margin profile and growth numbers in the short term. In their press release and investor presentation, they very clearly call this out, that they are now going back on that in a way and focusing more on tier 2, tier 3 expansion, which comes with its own sets of challenges. Customer profiles are different, the store economics are different. But I think that reset is what's happening right now. I don't expect the growth number to be so low going forward. We do build in a 20% growth CAGR over a next 3-year period. So that's, I think, the first point. We believe growth will return, not to 25 or 30% levels, but to 20% levels. On margins, I do believe this margin is sustainable. Right? It cannot improve from here, but it is sustainable because it comes on the back of investments into technology, which they have done, largely because their employee costs have gone down and their other operating expenses, especially logistics, etc., are giving them scale-based efficiencies.
Jignanshu, you spoke about the fact that, the street is penciling in a lower growth rate for Trent. If that is the situation and that and Trent is able to maintain that 20 to 25% range growth for the top line, do you see now a steep correction or derating of the PE for Trent as well?
See, I think the PE in a way has derated faster if you look at the stock price than the growth expectations have derated. We still believe that there is a 22 or 21-22% growth expectation. We are slightly below the street in that, but we do keep it at a 60 odd multiple, given the fact that we expect the franchise to do well. They are making all the right decisions, all the right choices in terms of where to open stores, how much to churn the inventory, how quickly, how to react to competition. So as a franchise, I don't expect the best fashion franchise in India to derate. Of course, until the growth tanks below this. Like we don't right now. I don't think the valuation factors in a scenario where the growth tanks further. If that happens, I think that I can expect. That's the only scenario where I expect a significant derating from here on.
Jignanshu, so the key upside here is going to be growth coming back, right? I'm trying to understand where have things gone wrong with regard to growth. Is it the higher competition? And as they enter tier 2, tier 3, you're seeing some of the other value retailers also being present, and they will be very real competition for Trent. Is that at all a risk, growth coming back itself?
Yeah, fair enough. So where has it gone wrong? I think it's a combination of many problems. One was, as we have discussed, over cannibalization of stores, which hurts, but it's a time effect. Second is they've sort of reached the market share ceiling in some markets where there is a brand fatigue, which always happens with fashion retailers because people don't want to wear the same clothes that they see many other people wearing. So there is a natural ceiling of market share then that a fashion retailer can get in any micro market. That's the second thing. The third thing is that their store growth became a little erratic because they needed larger stores and they wanted to go to new cities, which needed replanning in the organizational. Fourth is consumption overall, a softer consumption environment, especially in urban areas. And then the fifth part is competition. And even in urban areas, we do see increased competition, though the impact is lower in our view, but there is obviously some impact. When they go to tier 2, tier 3, Harsh, for your second part of the question, I expect the competition to be there, but not as severe as what they actually saw in metros and tier 1. Because the competition, I do believe that the positioning that, let's say, a Vishal Mega Mart or a V Mart or even a V2 retail has is slightly different from the positioning that a Zudio has. I think Zudio is far more younger population, far more fashionable clothes, if I were to say that. Whereas the other value retailers are more family oriented value propositions across ages, as well as a lot of basics in their design. Whereas Zudio has a lot more fashion in its design. It's there will be some competition, but I think not more than what they've faced in metros.
Jignanshu, I have to address what's happening with Eternal and Swiggy, right? A, of course, is the churn at Eternal with the leadership transition, and then of course the QC cash burn clearly continues. Versus, how does it stack up with Swiggy's profitability timelines?
I think you buy or today you look at Eternal and Swiggy from very different perspectives. In our view, between the two of them, Eternal is very clearly somebody who leads both food delivery and quick commerce markets. It's ahead in the curve on profit and on growth, and hence it is sort of the deemed market leader from 3, 4, 5 year perspective. Right? Swiggy is more of a turnaround story or of an evolution story of its Instamart business, where they are behind the curve in terms of Blinkit, but are catching up. So we do expect their contribution margin to break even by the first quarter of F27, as the management has guided, and our math indicates it's possible. The journey from there to EBITDA break even will be dependent on competitive intensity as well as their own operating excellence. And hence, I think that is a little bit more uncertain and very difficult to put the timeline at. However, they do have enough cash to sustain themselves over that time period, whether that time period is 3 quarters, 5 quarters, 8 quarters, and hence not a challenge. The entire sector, though, I think we need to be careful today of what the competition is doing, whether it is Zepto, whether it is Flipkart or Amazon or Reliance. We do believe that aggression is going to keep the earnings profile of both Blinkit as well as Instamart more volatile than expected in the next few quarters. The competition is real and it is here to stay.
Jignanshu, with regard to your preference between an Eternal, and I'll come to QSR because that's the other very important space which seems to be at an inflection point. So I'm curious about that. But with regard to Eternal and Swiggy, your preference or your tilt seems to be towards Swiggy, even though Eternal seems to be doing much better on the QCOM front, and that is where a bulk of the valuation typically comes from. You believe that a single player market can exist in this and Swiggy will likely get priced out, or that's like a far cry and Swiggy will give, or if I can word this differently, will give stiff competition to Eternal? Can that happen?
See, Harsh, I think the market is large enough and devoid of any structural moat, which we believe will restrict it from becoming a two-player market like we have seen on food delivery or we have seen in ride-hailing or many other areas of internet e-commerce. In this scenario, there is very limited friction for the customer to really shift, and hence at a micro market level or even at a city level, it is possible for multiple players to coexist and become profitable even with slightly smaller scales. So we do think that that there is a case for multiple players to coexist in this market and not become a two-player duopoly. With
Makes
that,
sense.
the rationale for Eternal versus Swiggy, I think, is different. I would say that Swiggy, as of today, at current share price, is a very tactical play that there is very limited share valuation for its Instamart business, and we do feel that that part of the business is undervalued today at the current share price. For Eternal, a part of the performance is valued. What is not is improvement in competitive intensity, right, which will help them go back to better growth and better margins. So I would say there are different thought processes. Swiggy will sustain, but short term we would play because of valuations. Eternal, I think, still seems to be between the two of them that it will definitely remain the market leader for the 3 to 4 year period.
And Jignanshu, QSR, is that probably one sector space which has been depressed for a while now? Are we at an inflection point, and can it sustain, and therefore can it re-rate?
Yes, so I think QSRs are an interesting play today. They need discretionary demand to come back. I think across all the four firms over the last 2 years, they have made a lot of effort on menu innovation, on reducing the cost structure at their stores to leverage margins once sort of demand comes back. But they are now, I think, at a situation where incremental efforts from them are dilutive in terms of impact. So they need the broad-based consumption scenario to improve, and that the commentary from yesterday from Devyani and Westlife indicates that January is better, but whether that better will sustain over the full quarter or not is unknown yet. Right? So I think until that happens and people get conviction in demand coming back, the names will sort of struggle for performance. And we have seen that margin expansion is not really why investors love these companies. It's only for growth. And the growth has been very, very, very disappointing across the entire sector, right, for a couple of years, barring Jubilant, of course. So I think the expectation from Jubilant is different, and the expectation from the rest of the pack is sort of different over this year. Inflection point, tough to say, Harsh. I would say wait a little, and we need broader demand to come back before the stocks can inflect.
Understood. So much insight. Jignanshu, thanks as always for your time.
As usual. Thank you so much. Pleasure.
Okay, let's take a very quick break on that note. When we come back, of course, we'll have a fundamental expert as well join in to talk about the overall market. But like I said, bringing the budget discussions on